Good afternoon again, everyone, and welcome to today's webinar, which we have called How Conflict Shapes the Global Economy. Thank you all for taking the time to join us. My name is Ray Calleja, as many of you know. I'm the head of wealth management at MeDirect here in Malta, and I'll be hosting today's session. At MeDirect, obviously, we strongly believe in the importance of providing our clients with clear, high quality, and reliable insights to help navigate an increasingly complex investment landscape. This is why we partner with globally respected institutions such as Invesco. For those who may not be familiar, Invesco is one of the world's leading independent investment management firms managing assets globally across equities, fixed income, and multi-asset strategies, and serving clients in more than 20 countries. It is therefore our pleasure to introduce today's speaker, Ben Jones, or Benjamin Jones, who's the Global Head of Research with an Invesco Strategy and Insights team. Ben will be presenting how conflict shapes the global economy, where he will share his perspectives on how today's evolving global landscape is influencing economies and investment markets. Ben, first of all, thank you very much for joining us today, and to all our clients, thank you for your continued trust and for being with us today. However, just before I hand over to Ben, just a quick housekeeping note. If you have any questions during the session, please feel free to submit them through the Q&A function on your screen. Ben will address these at the end of his presentation. With that, Ben, the floor is yours, and thank you once again for joining us.
Thank you very much, Ray, and thank you very much for everybody joining this evening. Wonderful to speak to you. Obviously, an awful lot that we could talk about today, but we're going to focus on this idea that we are living in a world that is becoming more disrupted, and it's not just disruption that we've seen in 2026. It's disruption that we've really seen over several years with the COVID pandemic, with the conflict between Russia and Ukraine, and now the conflict that we're seeing now. How does that change the way that we view the investment landscape? And is it an investment landscape that we should be deeply concerned and worried about? Or is it one where there are lots of opportunities for investor? And not to spoil the punchline, what I would say is there are an awful lot of opportunities today, and panic is definitely not the right course of action. So we're going to go through a few things, predominantly around the geopolitics, and some of the things that I am rethinking at the moment. There's a lot of lessons that I've learned over my 20-year career, but I think the changes that we're seeing in the last few years and going through 2026 caused me to rethink some of those models, some of those frameworks, and some of those approaches that I've taken before. And that, I think, is going to help me be a better investor in the coming years and decades ahead. So if we jump into it, what I'm seeing at the moment is a world that is disrupted. I do see a world where I'm rethinking the global world order, not just the way that I've grown up and invested over the last 20 years, but a lot of frameworks, a lot of institutions that have been solidly in place for the better part of 50, 60, 70 years are changing. We'll think about the Middle East in particular and think, what does that make us rethink and challenge? We'll have a bit of a touch on the AI space. Are we outsourcing our thinking? And always when I do this, I always ask the question, do I need to rethink my career choice? Is AI going to replace me? Will it do a better job at these webinars in a year's time or so? I'll let you be the judge of that. And then we'll think about what we're changing in terms of our core views over the coming year or so. And then specifically, I think the most important part for long-term investors, rethinking what a diversified portfolio looks like, because that's really a lot of what long-term investors want to do. They want to build resilient, diversified portfolios that can help us weather this disruptive world. The image on the side, obviously AI generated. We're all generating these wonderful AI images now, designed to really illustrate a point that I think is important now. We are moving from an environment of one of abundance to one of a greater degree of scarcity, and one where trust and security are going to derive a greater premium. So that's security in defense security, but it's also security around labor markets, around balance sheet security, around energy security, and we could also delve into food and water security. That's a bit of a step too far for today, but keep those things in mind. So the next chart that I'm going to show you here is one that I've been using for a number of years, actually for about 3 years. And what it shows you is across the world today, there are more conflicts taking place around the world than we've seen at any point since the end of the Second World War. So there's a Dutch institution that puts this material together, and it shows the number of interstate conflicts that are taking place around the world. And essentially what you can see is that is at a high level. Now that last data point is as of 2024. Today, we obviously know there are more conflicts taking place. Now, the reason that I've been using this chart for a long period of time is because what it shows you is the world is becoming more fragmented. There is more conflict around the world, and that means that governments around the world are going to spend more on defense going forward. They are going to spend more building out and expanding their militaries going forward. And if I go back over the long arc of history, what I can say is defense spending tends to be inflationary because there's this clamoring for resources. To build out a military, you need people and you need materials. That tends to have an inflationary impact. Think about this idea of inflation. I'm going to keep coming back to it again and again. So unfortunately, the world is not getting safer. Actually, it does appear to be getting a little bit more dangerous. The next few charts, and I'll cycle through a few of these, is this idea that we have this freedom of shipping around the world. Now, if you think about the post-Second World War period, what we've had is greater and greater integration of supply chains. Supply chains have increasingly become about being hyper efficient, just-in-time production, and that allowed companies to expand their margins. And the idea really was that you produce products, you derive materials from the cheapest place that you can produce them, and then you move them to their end point of sale, and it's very cheap to move those items to their end point of sale. But unfortunately, that is being challenged now. Now, obviously, the thing that we are focused on today is this little 21-mile strip of water, the Strait of Hormuz, which carries about 20% of the world's energy supplies out of the Middle East and onto global markets. It's not just oil supplies, it's not just gas supplies, it's actually helium, it's fertilizer for food, aluminium as well. There's lots of resources actually that come out through this little tiny choke point, or rather at the moment, are not coming out of this choke point. So the one key chart that my team is looking at on a daily basis at the moment is this right-hand chart. How many ships are transiting the Strait of Hormuz? And I will be honest, this has not recovered as quickly as I thought it was, or many people thought it was going to recover. At the moment, ships are not transiting through that region. So we're watching this very closely from a short-term perspective, because when that does pick up, that's going to be a relief. I think that'll be very positive for markets. But the longer this goes on, the more near-term trouble we have for economies, because you are going to get those supply shortages. But this idea of rethinking the freedom of shipping is not just confined to this one little area. The Iranians have threatened to charge for ships to go through the Strait of Hormuz. Effectively, let's be honest, protection money. Other marine choke points are being threatened with the same thing. Indonesia, a few weeks ago, floated the idea of charging a toll to go through the Strait of Malacca, a very, very important marine choke point down here in Asia. That could suddenly be the next flare-up. And essentially what has happened is that the tensions that we've seen in the Middle East have shown that, well, you know what? The US command of the seas, this idea of the free movement of shipping, is going to be challenged going forward. We can't necessarily rely on that going forward. It's not the only area. Just a few years ago, what we saw was the Houthis starting to attack ships in the Red Sea over here. This is the Bab el-Mandeb choke point. And you can see this is the number of ships that were passing through that choke point collapsed in 2024. Now, actually, there haven't been any material attacks by the Houthis on ships in that region since then, but the shipping traffic hasn't recovered. Now, that's partly because for this area, you can go round the Cape of Good Hope. You can go around the bottom of Africa, so there is an alternative. But again, that takes longer. It adds cost to the system. It adds inflation to the system. We could also then go over to the other side of the world and we could look at the Panama Canal. Now, at the moment, the Panama Canal is operating more or less normally, but that wasn't the case in the beginning of 2024. You saw a significant drop in the number of ships that were able to pass through the Panama Canal. Now, this wasn't actually just to do with geopolitical issues. It was more to do with weather conditions. We saw falling rainfall. We saw the water levels in the Panama Canal fall significantly, which meant that you couldn't take the largest ships, or rather fully laden ships, through this area. Again, so what this means is the sort of climate issues, the weather issues that we're seeing can also have a detrimental impact on shipping. Put all these things together, you've got higher levels of inflation than we've been used to in the past. Now I'm going to pivot now, and unfortunately I'm going to give you a very pessimistic slide on the next slide, and I apologize to everybody listening here, but we are all getting older. You are all getting older, unfortunately, and unfortunately you are also all having fewer children than we've had in the past. And what that means is that global working age populations are shrinking. So over the last 20, 30 years or so, we've effectively had a demographic dividend, particularly emanating out of China and Asia. What you've had is a growing global workforce, particularly in China, as people moved from rural areas into urban areas and built out production in those areas. So these lines all picking up into the early 2000s is the number of working age people relative to the total population. That is now going into reverse, and these lines are forecast to fall quite quickly over the coming decades. Now, what that means, if you think about this from a economics first principles basis, is that if you have fewer people working relative to the total population, that potentially puts upward pressure on wages, upward pressure on inflation. The right-hand chart shows you the fertility rates across a range of countries. The latest data point here is 2024, and you can see that many of these countries now well below the 2.1 replacement rate that we'd want to see to maintain a consistent population, far below the birth rates that we saw in 1960. I'll give you a very quick little anecdote on South Korea. In South Korea last year, there were more prams sold for pets than there were for children. People are just having far fewer children in South Korea at the moment. And the latest data that I'm looking at that's starting to come out over recent weeks or so suggests that this actually is accelerating. Now, just to be clear, some of the reasons for these numbers to fall are really, really good reasons that we have to absolutely celebrate. Better female education, for example, better opportunities for women to enter the workforce, far lower mortality rates as well. Children obviously living a lot longer in many of these areas. These are very good things that we should celebrate, but they do cause some economic challenges. Let's then turn to artificial intelligence. What about artificial intelligence? How worried should we be about this? Well, there was a paper written at the latter part of February by Citrini Research, the 2028 Global Intelligence Crisis. And for anybody that works in the knowledge space or anyone that has teenage children like I do, this was a very troubling paper, because what it essentially said was that all white collar jobs, the kind of job that I'm doing right here, right now, is going to be replaced by artificial intelligence within 18 months, just 18 months. Now, to be clear, this paper was very much just setting out one potential scenario. It wasn't a forecast, and it wasn't written by one of the big banks like Goldman Sachs or anything like that. It was outlining a forecast, outlining a prediction, outlining a scenario. This is why AI would do a better job than I would. But what happened in the immediate aftermath of this paper coming out is a lot of the software companies lost a significant amount of money. You had about $500 billion wiped off the US software companies in response to this, because a lot of people are going, well, we don't need the software companies because we can all go and use Claude Code and we can replace all this software, for example. Now, if you take this to the extreme and say, okay, AI is going to replace me, it is going to replace Ray, for example, then that has profound implications for the way that the capitalist system operates. Because as you can see on the right-hand chart here, around about 50% of the tax revenue that's paid in the US, and it's similar for the UK and other OECD countries, comes from income tax. So if Ray and I don't have a job, we don't make any money, we don't pay any income tax. How do you fund a government? These are big challenges. Now, again, I do not think this is actually going to play out. Again, this was painting an interesting scenarios and a thought process exercise, but it is something that tells you that the nature and framework of the way that we work is being disrupted and is changing. And this comes against a period where you have very high levels of public debt in developed markets. So this chart I'm using is UK government debt. The reason that I use UK government debt, I could use US or I could use French, for example, or even Japanese, and you'd get a similar profile. But the UK is a nice one because it goes back to the 1700s. And if you ever see me speak, you'll know that I'm a bit of a sucker for these really long-term charts. But what you can see here is that government debt is up at getting on for about 100% of GDP. It has been higher in the past, at the end of the Second World War, at the end of the Napoleonic Wars. Now, the question I ask myself is, well, how do you deal with this government debt? Well, it's quite simple. What you could do is you could raise taxes and you can cut spending. And in theory, that should reduce the debt that you have. But politically, that is impossible to do at the moment. That just does not fly with the current electorate. So the other incentive, or the other way that governments can deal with this debt level, is they can inflate that away. They can run the economy hot. They can have higher levels of inflation, higher levels of nominal growth as well. And that's the sort of the base sort of backdrop that I think we have moved into over the course of recent years. So a lot of those charts that I've shown you there are perhaps pessimistic, don't sound particularly optimistic, maybe a little bit worrisome, but actually for investors, I don't think it is as pessimistic as that necessarily sounds, but it does require us to rethink some of the way that we think about markets and some of the way that we think about investing today. So let's jump into the so what. So what does this mean? Well, let's start off with the really near term, for example. We have a global conflict taking place in the Middle East at the moment, and it's obviously a very severe conflict that is taking place. But what does that mean for global equities? Does that mean you should be selling equities and going to cash and going to safe haven assets? Well, actually, history tells you absolutely not. What I've done with this chart is I've gone back over the last 50 years or so, and I've said when we've seen other significant geopolitical events, predominantly I've here centered on Middle East, but I've also factored in things like 9/11 in 2001, the Paris terror attacks, for example, and the NATO-Yugoslavia conflict in 1999. And then I've said when we've seen the outset of these geopolitical events, what happens to global equities, so using MSCI All Country World, not just US equities, global equities, what happens to global equities in the year after? And on average, global equities are up about 8%, 7.8% in the subsequent 12 months. So on average, this says, when you see a global geopolitical event, stay invested, equities are more likely to be higher over the course of the next year. And this very much happened in the Russia-Afghanistan conflict in 1979, the Falklands conflict, and US-Iraq in 2003. Now, there are some exceptions. 1973 with the Yom Kippur was one of them. Something fundamentally changed. There was a very significant supply shock. In the US, there was queues at gasoline stations. You could not get fuel to put in your car. and the prices went up very significantly destroyed demand. Similarly, that happened particularly here in Europe in 2022, when we saw gas prices significantly spike higher. 2001, September the 11th, was a little bit of a different one, because that wasn't really the geopolitical event and the attacks in New York that caused this. It was the fact that we were coming out of the dot-com era, so you were already in that bear market, so we can kind of discount that. But essentially what we need to ask ourselves is this going to be a geopolitical event again like this, in which case equities rally, exactly what we've seen over recent months, or is this going to be something more fundamental like 1973, like 2022? Now, markets have reacted as if the normal sort of historical playbook is likely to play out. And I think that's partly also because people have very much clear in their minds last April. Last April, we had Liberation Day, and Trump stood up in the Rose Garden and said, we are going to slap these huge tariffs on a wide range of countries. Tariff rates are going to go up to levels that we haven't seen since the 1920s, for example. And equity markets sold off very, very aggressively on April the 2nd. And then on April the 9th, just 7 days later, you had a very significant rally in global equities. In fact, for US equities, that was the 10th best day for the S&P 500 in more than a century. So what that tells you actually is, for most investors, particularly investors that have a long-term view, staying invested is generally the right course of action. Now, at the moment, I don't think that we are shaping up to see something that is similar to 2002 and 1973. There are things that we're watching and things where we have to be cautious and very humble in our views. But if we look at the energy backdrop today, what we can see is the increase in oil prices has been significant in nominal terms. And don't get me wrong, when I go to the petrol station and put petrol in my car, it feels painful, and it's costing an awful lot more money. But real oil prices are still well below where they were in 2022, and they are still very far below where they were in 2007, 2008. So real oil prices aren't anywhere near as high as they were during these sort of higher periods at the moment. And that means that, as painful as this is, consumers at the moment can still deal with those higher oil prices. The other thing to think about when we compare today with, say, the 1970s, is that we have become just far more efficient at using energy today to produce a unit of GDP than we were in the 1970s. And we can see this just from looking around our own home. So above me, I've got LED lights now, which cost a fraction to run than what they would have with the sort of incandescent bulbs that we would have had in the 1970s. The fridge that I have in my kitchen is obviously infinitely more efficient than the fridge that my parents would have had in the 1970s, for example. And the same is true generally for industry. And that's what this right-hand chart shows you. It's the energy consumption per unit of GDP. It's coming down and down and down. And this means that we are more resilient. We can actually be a little bit more adaptive also to these high energy prices. But let's focus on that resiliency point for a second, because the other thing that you can say is that households are in a more resilient place today than they were in 2008, for example, when we had the global financial crisis. One of the core things that we're focused on at the moment is this idea that the private sector, be it households or be it corporates, have delevered quite a lot over recent years. So I'm showing you here UK and Eurozone households, the debt levels that they have relative to income. And you can see that that was very high in 2007, 2008. The similar picture for the US. We'd all sort of gone out and bought homes that we couldn't really afford, or we'd bought 2 or 3 homes, borrowed lots and lots of money. And what that meant was that when there was a shock that hit the system, it got passed out through the system very quickly. We had to delever. We weren't resilient. We weren't able to deal with those shocks very, very well. But today, these debt levels are much lower. And actually what I'm seeing in some of the more near-term data is that we are seeing a pickup in loan growth. We're starting to see households and corporates borrow a little bit more, starting to invest a little bit more. Capital spending is starting to improve a little bit. And I think this resiliency argument, this ability for both corporates, households around the world to deal with these shocks, can explain why over the last 18 months, we have seen a series of shocks with Liberation Day, for example, and clearly the Middle East conflict being the two biggest that we've seen in the last 18 months. And economies and markets have continued to move higher and continue to hold up in that environment. In fact, if I look at this left-hand chart, what this shows you is Citi's Global Economic Surprise Index. What this is telling you is the economic data that are being released, things like unemployment, GDP growth, for example, across the world are coming in better than expected. And in fact, that has been coming in better than expected at every single point since January of last year. This line has not been negative since January of last year. Now, the labour market in the US is one where people have a little bit of concern at the moment. But I look at the US labour market and I go, actually, the labour market is pretty strong. It's pretty resilient right now. Initial jobless claims. This is the number of people on a weekly basis that are filing for unemployment benefit, starting to file for unemployment benefit. That number is at its lowest point today since 1969. Since 1969, it has not been lower. Now, we saw recent payroll growth in the US, the number of jobs being created. We've had 2 months of quite solid payroll growth. And that is against an environment where the total workforce, labor force, is actually shrinking in the US because we have this clamp down on immigration and rather sort of trying to force people out of the US at the moment. So that means actually that the unemployment rate is not likely to spike higher. That is something to watch closely, though, because if you get an increase in unemployment, this is one of the risks that we're always cognizant of. If you get higher unemployment, that is when households, consumers, people start to tighten their belts. Companies also start to tighten their belts. That would be the thing that would tip you over into a recession. So we're watching the labour market like a hawk. The other thing that I'm watching very closely here on the left-hand side is recent earnings season. So what corporates are reporting. And if I look to US banks, they can give me a very good signal of whether there are stresses in the economy. This is new loan loss provisions. So essentially banks saying we're putting aside this money because we think that our customers are going to default on their loans. And you can see here that that's been very, very steady into the beginning part of 2026. Now, what you might say is, but Ben, surely banks are just behind the curve and the conflict didn't really start until the beginning of March. And actually what they're just doing is they are being too complacent. But actually, if we go back to 2020 and look what happened in Q1 of 2020, and remember Q1 of 2020, we weren't really sure what the pandemic was around. I was still going on holiday in the first quarter of 2020, but banks did put aside these big provisions. They did see that something was changing very quickly. Banks are pretty savvy at seeing that forward-looking conditions change. We're not seeing that at the moment. So this is a positive signal as well. The other thing that I want to highlight is that if you look at not just the US, but I'm going to focus on the US with this right-hand chart, the fiscal picture, the amount of money that governments are pumping into the system is actually quite positive at the moment. So we can think about that from a European perspective. I will show you a chart on that in a second. But in the US, we have these income tax refunds being sent out at the moment. This is a function of the One Big Beautiful Bill. That is running at about $60 billion more than it was in 2025. That's about a 20% increase, a little bit above. That money is going into households and consumers' pockets. And what they're doing with that is partly paying down debt, but also partly spending it. So the consumer and the household around the world is in relatively robust fashion. That's a key part of the economy. The other key part, obviously, that you've all heard about and all see in the news is the AI story. And where is the AI story most clear? Well, it's in places like Korea. Korea makes a lot of the memory chips. It's companies like SK Hynix, companies like Samsung, for example. Prices have gone up significantly. Demand is very, very strong for those products. And what you see is Korean exports are growing very, very quickly, about 50% year on year. That's this light blue line that has spiked up here. The dark blue line that I've put on here is global corporate earnings growth. So are corporate earnings growth growing or falling over the subsequent 12 months? And you can see that there is quite a strong link with that. And that suggests that corporate earnings growth will continue to grow. The right-hand chart then says, okay, but what is the analyst community? So the people that speak to me on a regular basis that are looking at individual companies and trying to analyze whether their earnings are going to grow or whether they're going to fall. What are they saying about these earnings at the moment? And this is right up to date. I updated this chart yesterday morning. This chart being positive, what it says is that analysts are posting more upgrades than downgrades. So they're saying that earnings are likely to grow more quickly than we've previously expected, not more slowly than previously expected. This is a pretty decent signal that earnings growth can continue. So hopefully that leaves you in a relatively sort of positive mindset in terms of the very near term that we are looking at and seeing in markets at the moment. I'll come back right at the end and just talk about some of the areas that we really sort of favour and prefer right now. But I just want to take you back to that idea of higher levels of inflation quickly, because this is again a nice long-term chart. It goes back 75 years. Looks at the US and it looks at US CPI inflation, so the headline inflation that we mainly all focus on. And what I want to point out to you is this period here between the global financial crisis and 2022. Inflation was, generally speaking, below the 2% target and didn't really fluctuate very much. There wasn't a lot of variation in inflation. And that period there, if you look back over the last 75 years, was the unusual period. That is unusual compared to what we've seen, certainly through the 1970s, even through the 1980s and 90s, perhaps a little bit more similar to what you saw in the post-Second World War, this non-inflationary growth period that was coming through. But essentially, the low, stable inflation period was unusual. Now, why do I say that's important? Well, I say that's important because for many, many people, that's all they've lived with. That's all they know. I've got people in my team that were born just around the global financial crisis that do not really remember that crisis at all. I started my career only just before the global financial crisis period. So that's what we all have in our mind of going, that's the way the world works. That's the way it should work. My argument to you is just take a step back, think about the longer term. And for me, in this period of greater degree of global fragmentation, that likely means that we have higher levels of inflation, something that is more akin to the 1970s and perhaps to a degree the 1980s. Now, for investors, when you're building a portfolio, what does that mean? Well, it means you need to consider this next chart very carefully. This is the correlation between bonds and equities. And again, over the last 20 years or so, generally speaking, that correlation has been negative. What that means is that if you put a bond and equity portfolio together, when bad things happen, your equities go down, like they did in 2008, like they did in 2020, but bonds perform well. Bond price yields go down, bond prices go up. You've got those great diversification benefits. But if you're in an environment where inflation is higher, supply shocks are higher, bonds do not offer you the same diversification characteristics that they have done in the past. So in March of this year, bonds and equities went down together. Bonds have been the less good performing assets over the course of the whole of 2026, but they went down in March alongside equities. The same happened, of course, in 2022. My argument is that that is an environment that I think is going to be more frequent and we need to get used to a greater degree. Now, again, this is not a reason for panic, and equally, it is not a reason for throwing fixed income completely out of your portfolio, but it's about thinking about what does fixed income offer me in my portfolio. And I think it offers you the income component. Yields are higher. The income you can get from fixed income is higher at the moment. But the diversification benefits in your portfolio need to come from other assets, perhaps shorter duration assets. So instruments that have a floating rate, for example, or commodities, for example, or real estate, for example, other alternative assets. Those are the questions I think you need to be having today when you're trying to build that resilient portfolio. Okay, so the next few slides just to run through some of the other big changes that we're seeing at the moment. A lot of people do ask me about Europe at the moment, and is Europe going to get its act together? Is Europe going to spend more on defense and infrastructure? And my argument is yes, it is. So if you think that Germany won't rearm, I would say think again, because it is rearming. Now, I apologize for this left-hand chart because it is a bit of a messy chart, but it is a really important one. What this shows you is Germany ordering weapons and ammunition from either the US, Europe, or its own domestic companies. And you can see this blue spike in 2022, this blue spike in 2022 that rises up. That is when Russia invaded Ukraine and Germany ordered weapons and ammunition from the US from companies like Raytheon, for example. But look at this light blue line at the end, that spike now. Germany is ordering weapons and ammunition from domestic companies, so from the likes of Rheinmetall, for example. And you hear reports now, not quite of Mercedes and VW, for example, producing weapons, but producing materials to go into the defense complex. So Germany has the ability to produce these materials, and Germany is producing these materials. The right-hand chart as well, I think, is super interesting right now. And you will have heard, I'm sure, and read in the press around China not supplying rare earth magnets to the US, for example. And what you might think is that China is hoarding these rare earth magnets. I would argue it's not. It's just changing where it's supplying them to. So it's not supplying the US and Mexico with as many of these rare earth magnets as it has in the past, but it is supplying them to Germany. It is supplying them to Thailand. And these are the critical inputs that go into sort of high-tech equipment, and particularly military equipment as well. So I think keep this in mind as well, and this is a reason for thinking a little bit more positively about the European area at the moment. Core also to my view at the moment, and again a way of, I think, changing the way that you think about forming portfolios, is this idea that the dollar is likely to weaken. The dollar did weaken a lot last year. In fact, it weakened more in 2025 than it did in 1973. Why do I say 1973? Well, 1973 was the year that the US came off the gold standard. It was the year of the Nixon shock. So a big, meaningful period, and started a period of significant dollar weakness. But think about where we've come from. We've had many, many years of dollar strength over the course of the last sort of 10, 15 years or so. The dollar is still looking overvalued on most conventional metrics, in this case, a real effective exchange rate measure. I also think there is just this degree of a lack of trust in the US now that it's broken down compared to what we've had over the last 50, 60 years or so. And just a lack of flows and money going into the US compared to what we've seen before will put some downward pressure on the dollar. So core to my view is the dollar weakens. Now, assuming that I'm correct, and you may have a different view, but assuming that I'm correct for a second, if you think the dollar is going to weaken, that is a very good tailwind for emerging market equities in particular, and emerging market debt at the moment as well. So this chart shows you the performance on a calendar year basis of the dollar and emerging markets relative to developed markets. When these bars are negative, as they were in 2017 and as they were last year, what that is telling you is the dollar is going down and emerging markets are outperforming developed markets. There are a lot of good reasons for this to happen. Lots of emerging markets fund in dollars. A weaker dollar eases those funding conditions. But this is one of those relationships that I think is going to hold up pretty well, and we'll see continued outperformance of emerging markets. And look, emerging market debt looks really attractive now. So I showed you a chart earlier of UK government debt. It was very, very high. I could show you French, I could show you US, it would be very, very high. And in fact, that's kind of what these bars here on the left-hand side show you. They show you levels of non-financial debt to GDP across a wide range of countries. The areas that I've highlighted in blue there are emerging markets. More of them are towards the right-hand side of that chart there. And what that means is that those debt levels are lower. There's less stress in those areas. And also, if you're looking for income in your portfolio, if you want some yield in your portfolio, emerging markets is the place to go. That's the place on the right-hand side here. The higher levels of nominal yield, the high levels of real yield that you get on these assets relative to developed markets are quite attractive at the moment. Final thing I'll finish up with, and then we will jump into Q&A, is on this idea of an AI bubble. I do not think we're in an AI bubble. If we look at the multiples that we see on the US technology sector at the moment, they obviously have risen quite a lot in recent years, but they are not at the level that we saw in the dot-com period at the end of the late 1990s. We're also not sitting here coming up with new valuation metrics. So in the late 1990s, you would have probably heard about valuation metrics like price to clicks or price to eyeballs, for examples, rather than price to sales or price to earnings that we can properly put into a spreadsheet. And equally, what we are seeing is this significant spending by the major hyperscalers, the Microsofts, the Oracles, the Alphabets and things of this world continuing. And we saw that a bit with NVIDIA's results last night. My sense is there is very much a scarcity in compute. I am certainly using AI more and more on a daily basis, sometimes bumping up against the limits of the tokens that I'm allowed to use. For example, it is becoming more and more embedded. So I think we've got a reasonable sort of runway for this to continue. Now, what I will say is that if we were sitting here at the end of 2024, I would have said to you, I think that Korean equities are an interesting place to be. I think they're going to benefit from the AI story. There's lots of other fundamental reasons why I think Korean equities are attractive. I will be perfectly honest with you. I would not have said that Korean equities were going to deliver a 75% return in 2025. And then sitting here in December 2025, I don't think I would have said to you that Korean equities would deliver a 71% return in the first 5.5 months of 2026. But that's exactly what we've seen. Perhaps even more baffling is that what we've then seen is that the multiples on these companies have actually gone down. They've become cheaper, even though you've seen the prices rise like they have. And that's because the earnings that these companies are deriving at the moment are just enormous. The earnings growth forecast for Korean equities this year is 233%. 233% year-on-year growth is what is forecast there. So let me pause there and say, where does that leave us? Well, I want to leave you with this final chart on the screen, and it shows you the performance of some key asset classes over the course of 2025. That's what you see on the horizontal axis here. And what you see on the vertical axis is the performance of these assets in 2026. And I've very clearly done this in euro terms because the dollar has moved significantly over this period as well. Now, what you can see is these sort of blue areas here, for example. What that's showing you is that non-US markets are outperforming US markets. core to the views that my team have held for the last 18 months is that rest of world equities are going to outperform US equities. That's our core view. And that played out very, very well in 2025, particularly when you factor in the currency moves. In 2026, it was working out spectacularly well until February the 27th, and then on February the 28th, performance started to change as the Middle East conflict broke out. But we still see that emerging markets and Japanese markets have outperformed the US this year, and fixed income, these sort of pink areas down here, are underperforming to a degree. Now, I generally want to remain of this position. There's certainly going to be some volatility in the short term, and the longer the conflict goes on, the longer the Strait of Hormuz is closed, the more challenging that is going to be for some emerging market countries and some European countries, and the US is likely to perform a little bit better. But when that conflict is resolved and we do start to get an improvement in traffic coming through the Strait of Hormuz again, I would fully expect to see particularly places like Europe and the UK moving significantly higher and outperforming the US. So predominantly we would continue to favour rest of world over the US at the moment, even if the near-term conviction in that view is a little bit less strong than it was a few months ago at the moment. And generally, we're still favouring certainly equities over fixed income at the moment in most of our portfolios. So I will stop speaking there and turn it back to you, Ray. Hopefully you've got a few questions for me.
Well, Ben, that was extremely interesting. Thank you very much. Very thought-provoking. I found myself putting down some notes, so I'm sure that the rest of our audience also found it very insightful and interesting. We do have one of the questions from Katya, who actually picked up early on about your presentation regarding the conflicts, specifically the Straits of Hormuz, and she's asking, why is the Panama Canal different from the Straits of Hormuz? Is it because it is a body of water inside the country of Panama, same like the Suez Canal in Egypt?
Yeah.
Thanks, Ben.
Sure. So it's similar in nature. So when you go through the Panama Canal that I've brought up here on the screen, you do have to pay a toll to move through the Panama Canal, and that's because it's a series of lock systems. So you have to pay for essentially for operations of those locks, the same as you have to pay here on the Suez Canal. And broadly speaking, to take a ship through the Suez Canal, it's about $1 million a ship to move through that area. Now the reason that we saw this drop here was weather related. If you haven't got the sheer sort of volume of water in the lakes around the Panama Canal, you can't fill the lock system, which means you can't get the water levels up high enough, and the ships that go through that area would then ground out. So what you were having to do in 2024 was get your ship to the beginning of it, unload some of the cargo, put it on the railway that runs parallel to the Panama Canal, run it down the end, and then reload it at the end. That added additional cost to the system. So this was less about sort of conflict, but the reason that I show it is because what it has highlighted is just another one of those marine choke points, those areas where if something goes wrong, in this case a climate or a weather issue, that it can become a problem and it can add cost to the system. Now, you don't have to go through the Panama Canal. You can do various different routes. So you could theoretically go around the bottom of South America here. Equally, if you're in Asia, you can go to Europe by going through the Suez Canal. You can go through here, or you can go around the other way around the world and then come back through the Panama Canal. Again, with the Suez Canal, it's not so much about an issue in Suez itself, unlike sort of the 1950s with the Suez crisis. It's more about this period down here with the Bab el-Mandeb, where Houthi ships are attacking. So in answer to your question, it is a bit different because it's less about conflict, but it is just around this area that you've got these little tiny points that we have kind of taken for granted that you can just get things through really, really easily, and that is changing in a number of different ways. And if you want to be confident that you can get your stuff, let's be honest, then what you do is you start to bring more of your production closer to home, or you diversify where you're putting your production sites. And by doing that, you add extra cost to the system, you add extra inflation to the system.
Thank you very much, Ben. We also have a question from Alona, who very interestingly also pointed out, asking about your views, Ben, about the price of gold for the rest of the year, and also would you consider it also as a safe haven still within somebody's portfolio?
That's a very good question. So you can see gold over here performed obviously very, very well last year, was performing very well in the beginning part of this year, and then has not performed very well at all during this crisis. It's actually fallen. It's one of the assets that has fallen the most since the outbreak of the conflict at the beginning of March. Now, what you might say is, well, why is that the case? Isn't gold the ultimate safe haven? It's supposed to protect you against these kind of events. It's supposed to protect you against inflation. Well, it does protect you against inflation when it's the kind of monetary inflation, when it's governments that are printing money, when it's inflation that's running higher through those areas. It doesn't protect you so well during a supply shock type inflation like we've seen over the course of the last few months, because in that period, what you see is that particularly governments and central banks, if they need liquidity, if they need money to, let's be honest, buy oil or buy gas, they will have to liquidate some of their central bank reserves to fund that. Now, the only country that I can point to and say this has happened in the last couple of months is Turkey. Now, Turkey publishes its gold data on a weekly basis. Many other countries publish it, but with a very significant lag, so we can't point directly. But Turkey has sold gold during the course of the last few months or so, and that has put some downward pressure on gold. So that explains the downward move. I do think that in this environment that I talked about earlier, in terms of high levels of government debt, for example, more fiscal intervention, that is an environment where gold has a solid place and a sort of role to play in your portfolio. Generally speaking, I don't have the charts in here, but what we've seen is central banks have been significantly buying gold since 2022. Now, why is that important? Well, because in 2022, when the Russia-Ukraine conflict broke out, the US sanctioned Russian central bank assets. It sanctioned those dollar assets. And that sent a message around the world to central banks that if you have your reserves in the dollar system and you're subject to the SWIFT payment system, the US can and will use the dollar as a weapon. And remember, of course, it was Biden that was in the White House when this happened. So that message has been sent around the world, essentially, that you want to, if you want to hold reserves and be confident in them, hold it in gold. And more interestingly, also hold that gold within your own borders. So we've seen a lot of gold being moved out of Switzerland or out of the UK and going to places like Poland or China or other places where they're holding it physically within their own borders. So yes, we've seen a bit of weakness in gold over the course of the last few months. I think it's easy to explain why we've seen that weakness, but I would be still holding gold in my portfolio as one of those diversifiers to the kind of risks that I think we're likely to see over the coming years.
Thank you, Ben. Questions are coming in thick and fast. Another one which is very interesting, obviously AI related, which I think you also in a way already answered, but I'll share the question. Given coming from Antoine Silvio, given the massive capital expenditure in AI infrastructure without proportional near-term revenue generation, what is the probability that the AI sector will experience a severe market crash akin to the dot-com era, which, as I said, probably already mentioned, but it would be interesting to hear your view again, Ben, please.
Yeah, no, look, it's a super question, because it is one where if that risk plays out, I think that could be very significant. Now, I don't put a high probability on it happening just sort of in and of itself. I think there has to be some form of external factor that causes it to happen. Because if you look at many of the hyperscaler companies at the moment, these are actually companies that are making very good revenue, do have lots of cash on their balance sheets, actually increasingly at the moment are increasing the dividends and buybacks that they're doing. So if you look at the likes of, and by the way, just be very, very clear, I'm not a stock analyst and I am not giving you any kind of stock tips or views here at all. I'm just talking about the fundamentals of these companies. But the likes of Microsoft and Alphabet, for example, these are companies that have very, very good revenue streams, very, very good cash flows at the moment. And they will send me bills, for example, and say, your Microsoft 365 license is going up by 30%, and I have to pay it. My children come in and go, Dad, I need to have a Gemini account with Google because I need to have Gemini on my watch and on my earbuds, for example. And all of a sudden, I'm then paying £20 a month also to those companies. These are subscription-based models where the revenues are quite sticky, and they are actually growing quite quickly. The poster child, of course, is Anthropic. Now, again, Anthropic, I'm hoping that Claude isn't listening to me when I say this, but Anthropic I spend $20 a month on at the moment, but I'm very close to going and spending $200 a month on it at the moment, because of the use that I'm getting out of it. I know that companies are spending a lot more, so that the revenue growth that we're seeing at the moment is accelerating quite quickly. Now, that maybe carries on, maybe it doesn't. And it might not, because what you might see is that China comes out and goes, you know what, here's a model that does sort of 90% of what the leading US models do, and we're going to give it to you for free. And that then potentially undermines some of these ideas. That was the fear that we saw on January the 27th last year with DeepSeek, for example. Also, what we could see is that China could come out and say, we have been able to produce an awful lot of memory. So memory is the reason why Korea has done so well with Samsung and SK Hynix, for example. There's this massive demand for memory at the moment to go into these data centers. Now, if China were to come out and go, again, we can produce this memory far more cheaply, that is potentially then somewhat of a negative for those companies in Korea, for example, and we need to watch that very, very closely, because history again tells us that you do get these cycles, that the cure for high prices is high prices. But at the moment, I don't see that immediately on the horizon. But you're absolutely right to raise it as a risk and raise it as something that we need to be watching for very, very closely to sort of change our views, because the macro implication of this is, I said to you earlier that US consumers generally are spending a lot of money. They haven't got a lot of debt. Well, part of the reason why they're less indebted is because where they have invested, their asset values have gone up a lot. The US households are sitting on net worth of about $183 trillion today, and a lot of that is in equity worth. If that goes down and goes significantly down, what you could get is that negative wealth effect when the values go down and then consumers stop spending, and then businesses start to lay off people and you get that downward spiral. So it's absolutely something that we have in our mind as a risk we're watching closely. But at the moment, I put a relatively small probability on that playing out in 2026 at least.
Thank you, Ben. We have more questions. Obviously, we'll try to fit them in because they're almost very, very interesting. Lara has asked something, in my opinion, which is very, very, very worrying as a topic. I'm talking about inflation. She asks, due to the Middle East issue, the price of crude oil has been high and currently is over $100. Although the US economy and consumer spending are resilient, the high prices of gasoline and treasury yields show fear of high inflation. what level of crude oil price would bring about a real negative effect on financial markets, and what other events could affect global markets?
Yeah, again, look, a great question. So at the level that we're seeing at the moment, what I would say is that consumers can deal with these levels. So, and I point to this left-hand chart that I showed you previously, the real oil price. The real oil price is not at the levels that we saw in 2022 or 2008. The sort of level that you need to get to for this really to significantly hit demand and have big demand destruction is probably above $150 a barrel. So that's the point. So I'd say anything north of $150 is really going to start to bite. Now, just to be clear, this is not to downplay the negative impacts, but what it does do, what we are seeing rather, is that it is hurting the lowest income consumers the most. So if you think about gasoline, in this case in the US, of how much people spend putting gasoline in their cars, it's about 2% of their disposable income. It's a relatively small amount. So US consumers will certainly get very annoyed around $5 a barrel, $5 a gallon to put fuel in their cars. It's definitely not good for the midterm elections from as far as Trump is concerned, but they will still keep doing it. But the problem in the US is it's the lowest income households. It's the sort of lowest 10 to 20%. They are going to really struggle because a higher degree of their spending does go on gasoline, for example. They're also being hit by high medical bills and things at the moment as well. So that's definitely a problem. Now, I'm going to say something that isn't necessarily pleasant right now, but from an economic perspective, the lowest income households don't really matter. They have to spend everything they spend anyway, but they're not the biggest contributor to earnings of consumer companies. That really comes from the middle and upper income households. And as while the middle and upper income households can continue to spend and can continue to deal with these high gasoline prices, that will carry on. What could happen, though, is that you get inflation coming through and second order inflation coming through and inflation expectations rising, and then central banks hiking interest rates. Now, I don't think that central banks should hike interest rates into this environment, because hiking interest rates is not going to get more oil pumped into the system. It's not going to open the Strait of Hormuz. All it's going to do actually is make it more painful from those lower income households that are more interest rate sensitive. But if central banks see that inflation expectations are rising, then they might hike interest rates. And if they do, that is potentially something that might be taken negatively by markets, particularly bond markets and equity markets. So I'd be watching that closely. Now, we see it in terms of pricing for the Bank of England, my home bank, for example, or even the Fed and the ECB, a little bit of hikes priced in. I don't think that is what is going to happen. In terms of other global events that could affect markets, well, we can talk about that definitely on the sort of positive and negative side. The AI side of things that we've talked about already, I think, is a key one that we need to watch. That's absolutely a risk that is out there, but equally it's something that if it continues to accelerate, can continue to support markets. Other conflicts around the world breaking out, I think potentially could be somewhat of a negative as well. But the most important signal that I would be looking at, the one factor that I would be looking at as a reason to get more negative, is ultimately the labour market. If there's some form of shock that we see, and the chances are it will be something that is one of those proverbial black swans coming along that cause unemployment to rise, that will be something that will cause us to get more negative on markets, because when people lose their jobs, they stop spending. That's the thing that we need to watch for. Exactly what that is, it will be something we haven't seen. It'll be like in 2020. Nobody foresaw the COVID pandemic, for example. And I know that's a little bit of a cop-out of an answer, but ultimately something that impacts labour markets is going to be the thing that gets us to become more negative on equity markets, certainly.
Thanks, Ben. Giuseppe picked up on one of the issues that you mentioned towards the very end of your presentation, Ben. It's about the UK and EU equities performance compared against that of the US equities. He said that picked up his attention. Is there any correlation between the UK and the EU equities outperforming the US ones and Trump's tariffs?
Actually, so the tariff impact is, I think, has had a lot less impact than many people had thought. But ironically, I think that the tariffs are ultimately, and actually a lot of Trump's actions, far from making America great again, are actually making Europe great again, both continental Europe and domestic UK here as well. Now, why do I say that? That sounds very strange, but let's be honest. Some of the things that President Trump has said he said them maybe in a not particularly pleasant way that we don't like, but the things that he said around Europe spending more on defense, spending more on infrastructure, being more self-sufficient are probably things that Europe needed to hear. And I think those things having an impact, and Europe investing more in infrastructure, the UK investing more domestically, ultimately is something that can be a positive for those markets. The other thing that we've seen is that it is forcing these countries to do deals and to increase trade alliances with different areas that they wouldn't have done in the past, or it's accelerated those deals. So we saw that with the UK and India recently, for example. We've seen it this week with the UK and the GCC, some of those Middle Eastern countries. So it's forcing these trading relationships to change and perhaps actually change to become more beneficial for Europe and the UK. The other thing to think about is, in hopefully the picture that I've painted, it is a world in which we get a greater degree of investment once again in those older economy industries. So in energy production, in reconfiguring supply chains, in building infrastructure, all of that takes physical input. You need copper, you need silver. One of the questions here was on silver, and just quickly, I do like silver as well. And building out the grid as well, building out energy, the clean energy transition. That is all something that is going to take stuff. Now, where are the companies listed that make that stuff? It's in the UK, it's in Europe. These are older economy sectors and industries, particularly in the UK, that has a higher weighting to energy and materials. There was actually a chart that I skipped over, but it was this chart here, which shows the energy transition is accelerating. Now, the energy transition is accelerating, but it's accelerating not because we've all had this sort of idea, oh, we're going to all be green, we're all going to be good, for example, we're all going to try to invest in low carbon industries. It picked up in 2022 through this period here because we realized that, oh, we don't want to be reliant on Russia for oil and gas anymore. We need to be more self-sufficient. The best way that you can be self-sufficient is to have solar, wind, and nuclear. So I see this accelerating. Now, that is a positive for Chinese companies, absolutely, but it's also somewhat of a positive for I realize I'm not sharing that screen, am I? That was apologies for that. This one here on the green energy transition, what we're seeing is this pickup in investment in the energy transition because we want to become more reliant. Now, that benefits Chinese companies in particular. It benefits the silver point that that one of the clients here mentioned as well, but also it benefits a lot of the European and UK companies as well.
Thank you, Ben. Actually, we can go along with another, to add to that. Ivan, actually, as you pointed out, mentioned the issue of silver, and especially in comparison with gold and AI infrastructure. Do you think, he asked, do you think that silver has stronger upside potential than gold over the medium term?
Over the medium term, yes. Now, it is one that is going to be a lot more volatile. silver is just a more volatile asset. Now, again, if we were sitting here at the end of 2024, I would have said to you that silver should outperform gold over the year, and it did to an enormous degree, and that relationship then got quite stretched. It then came back in a lot more towards the latter part of 2025 and early part of 2026. But if we think about silver, silver has both the benefits of the precious metal support. So like gold, it can be a precious metal, it can perform in your portfolios. I mean, so Invesco, for example, we're some of the biggest providers of the gold, silver, and platinum type ETF. So you can think of them from an investment perspective. But silver does also have the benefit of being an industrial material as well. And Ivan says it perfectly there. It is a big factor. It's a big input component in solar panels, for example. The other bit that Ivan mentions there, I think that is incredibly important in his question, is the AI infrastructure. What do you need to build out the AI infrastructure? You need an awful lot of energy to power these data centers. And how are you going to do that? Well, yes, you can do that with some conventional plants, but increasingly you can do it with solar and wind. You can get those plants up relatively quickly. You can do it with nuclear as well. That's why you've seen Microsoft, for example, moving to 3 Mile Island in the US. But essentially, yeah, silver plays into a lot of these different sort of medium and long-term themes. So yes, I'm happy to have it in the portfolio, and over the medium term, I think it probably does have a little bit more upside than gold, but I think essentially both of them perform pretty well in this environment.
Thanks, Ben. We have two final questions. We'll finish off the one from the Q&As. Philip is asking, what is your view on the outlook for entrepreneurial venture investing in Europe, Ben, please?
It's a good question, and I don't know if I have a great deal of confidence or a strong answer. But what I would say is that if I compare US and in Europe and certainly UK, there's definitely this culture of a lot more risk taking in the US than there is in Europe, unfortunately. And one of the ways that I characterize that is if I look at asset allocations of UK households or German households or French or Dutch or Italian households, compare that to US households, what we see is that Europeans and UK investors have an awful lot more cash sitting in their bank accounts. So the way that I tend to describe particularly the UK environment is it's a nation of savers rather than investors. Whereas in the US, what you tend to have is that people are generally invested. They have a lot more of their financial net worth sitting in equities. They're a lot more risk taking. Now, that doesn't directly answer the question in terms of entrepreneurial investing in Europe, but it is one signal, I think, in terms of that there's just greater risk taking in the US, and that's definitely a big positive for the US. The other headwind that you do have in terms of the entrepreneurial side over here in Europe is a greater degree of red tape and a greater degree of bureaucracy, and that has been something of a headwind. Now, what I would say is if you look at Germany, for example, they are trying to strip away some of that bureaucracy, and I think that's a positive. I think we are starting to see an increase in some of the private companies, particularly in the defense sector and around drone technology and things like that, and I think that's a positive. So I think there are improvements on that sort of entrepreneurial spirit in Europe, but unfortunately it's not as good as the US, and I think we're quite a long way behind on that, sadly.
Okay, the final question coming from my side, please, Ben. Something that you also pointed out and mentioned, which stuck out in obviously the significant and very impressive return from Korean equities. For somebody who's not invested there, have they missed the boat, or you still see upside on that score with Korean equities?
So I personally do still see upside on there. I think that this memory cycle has quite a long way to go. I personally think there are definitely challenges around investing in that space at the moment, and it is definitely a concentrated bet, because you are sort of betting on just the memory cycle continuing to improve. But personally speaking, I think there's probably a little bit more room to go. Yes, absolutely.
Okay, I think we can start to conclude. However, there's a couple of points I'd like to make. First of all, Ben, we truly appreciate you sharing your expertise and perspective.
Lovely to talk to you. Great questions.
Thank you. Yes, and it was obviously very timely and a very important topic, Ben. Also, would like to thank our audience, the people who joined us. But as I said before we close, I would like to highlight that MeDirect has recently implemented a significant reduction in online trading fees on our eWealth platform, making it even more cost efficient for you to trade and manage your investments. So therefore, obviously, we encourage you to take full advantage of these enhancements. And should you require any assistance or wish to discuss your investments or even your investment plans, please do not hesitate to get in touch with your relationship manager or contact our customer support team, obviously, on 2557-4400, who is calling us from Malta, and even, very easy to also drop us an email at info@medirect.com.mt. This brings us to the end of this very interesting webinar. Thank you again, Ben, and thank you, the general audience. We look forward to welcoming you again at our future events, and I wish everyone a good evening. Goodbye.
Thank you, Ray. Have a good evening, everyone. Bye-bye.
Same to you. Bye-bye. Bye.